Hey everybody. For anybody that doesn't know me, my name's Steve Vlasak. I'm the partner here at Richey that handles business development efforts for our alternative investments group. We work with hedge funds, private equity, venture capital, some real estate, digital assets, pretty much any size fund and strategy you could think of. We have a national practice in the US, as well as we do a lot of offshore work with Cayman and BVI. As I'm outward facing, having conversations with new launches or even existing clients, the topic of insurance comes up all the time. So we wanted to bring in our friend Patrick O'Brien over at Windermere, who's an expert on insurance for funds, to get his take on things and hear a little bit about his background.
Yeah, thanks, Steve. Appreciate that introduction. As you mentioned, I'm an insurance advisor with Windermere Insurance Group. We're located in Charlotte, North Carolina. The team that I lead focuses primarily on management and professional liability insurance, which would be E&O, D&O, cyber, crime, specifically targeted to investment advisors and asset managers across the country. We've been focused in this space for 10 plus years now and really strive to take an educational approach to our engagements with managers and advisors. So I'm excited to have the conversation today.
Excellent. We could just get started. Really what I did is list out questions I've received on previous calls. So let's kind of run through those. A lot of
Yeah.
these came from our current client base. I think the first question I get all the time is insurance required? Is it a regulatory requirement as a fund manager, or is it more of an optional benefit that I can consider?
Yeah, it's optional. There's currently no requirement for fund managers to carry insurance. I would say there's definitely a focus on compliance and practice management, just generally from the SEC and other regulators. But this is not currently a requirement. You may get requirements. It's not uncommon for insurance to be mandated by an institutional type investor to carry a certain level of E&O insurance or cyber insurance, but nothing regulatory at this point.
Gotcha. So since it's not required from a regulatory standpoint, if I'm a fund manager, what would be the benefits of having insurance? Why should I consider that? And I guess, are there different policies and areas to consider?
Yeah, definitely. There's many benefits, and I think maybe what would be helpful, I could just kind of quickly run through the core policies that a fund manager should be evaluating, and perhaps the benefits of each of those. So I'll start with cyber liability. The primary benefit of a cyber policy for a fund manager would really be, that it's designed to cover all the costs associated with a data breach event. So this could be, the forensic accounting work that needs to be done post breach, the rebuilding of the network and systems that might have been damaged during the event, a ransomware type attack. The policy can pay for that. Client notification and credit monitoring that's required if the breach resulted in sensitive client data being compromised. You may have requirements there around notification and credit monitoring. And then there's also the regulatory component where if you suffer a data breach as a fund manager, there may be regulatory requirements that they face coming out of the breach, and the cyber policy is really designed to be a one-stop shop to address all of those costs and kind of coordinate between vendors that you need to work with. I should probably also mention the cyber crime piece, which would be a fidelity bond, which is essentially just a crime policy written for fund managers and investment advisors. While the cyber policy is more designed to cover data breach costs, the crime policy can help indemnify the manager if they got tricked into sending either their own money or clients' money to a fraudulent location. It can also cover employee dishonesty if you had a rogue employee steal money, or cyber or theft by hacker if a hacker was able to directly steal client money. The E&O D&O coverage is combined into one policy, and the E&O piece of that is really designed to cover investor claims. So that's defense costs that are associated with a client or an investor bringing a lawsuit against you, and then any settlement or judgment that's ultimately awarded, the insurance can pay for all of those costs. It can also cover trading error losses. So if you need to fix, a mistake before it rises to the level of litigation with one of your clients, the policy can step in and indemnify you to make that client whole, so that you can keep your business moving. The D&O part of the E&O D&O policy, the primary benefit is really the enhanced regulatory coverage that it can provide for a manager in the event of a targeted regulatory investigation by the SEC. It's important to note that the D&O policy will not pay for fines and penalties that end up ultimately being assessed coming out of that action, but it should pay for the defense costs associated with, defending you in that situation. So, a lot of information there, but that's kind of the core insurance policies that we see managers evaluating and the benefits of each.
That was great. I appreciate that overview. Definitely very helpful on that front. A question I get all the time as I'm talking to startups or my existing client base, is there more exposure at a certain level of a fund? I mean, do you feel like an emerging manager has more exposure and need for insurance versus an established group with a larger AUM?
Yeah, not necessarily. I mean, I think the primary rating criteria for this insurance would be AUM. So I think, from the carrier's perspective, the more AUM you have, the more investors you have, the more risk you have, as well as the investment strategy. Obviously, that's a big piece of it. I think one thing that's important for emerging managers to at least just be aware of as they're starting to look at insurance is that all the carriers that write this insurance have minimum premium levels for coverage. So, if you have $5 million in AUM or $50 million in AUM, the pricing is going to be very close to the same. And so that's a conversation that we have early on with many emerging managers. For larger funds, more established funds, the pricing would obviously be above those minimum levels that you'd be seeing for an emerging manager, and they should be evaluating higher limits of coverage, which we can certainly help them with just based on our observations in this space and then some internal benchmarking materials that we have as well. And we're always happy to have that conversation around, hey, here's my strategy, here's my AUM, what would be an appropriate level of coverage for us.
Perfect. So I know AUM definitely drives, the policy and so on. As far as strategies, are there particular strategies that are more risky than others or that impact pricing? Because, one that comes to mind for us, we do a lot in the digital asset space and newer space, not as much information. So I just wanted to get your take on that.
Yeah, certainly. I mean, on digital assets and crypto specifically, I mean, the premiums are much higher for that sort of strategy. The deductibles that you would see are also much higher for those strategies. And then, just the universe of insurance carriers that are able to write the E&O and D&O for those strategies is smaller than it would be. On just the types of fund managers overall, I mean, I wouldn't say it's necessarily, one type of strategy needs to buy more insurance than the other. I'd say just traditionally, from our observations, private equity and venture capital would tend to maybe buy higher limits of coverage than you would see for a hedge fund or a real estate fund. But it's specific strategy and risk tolerance specific. Um, so, I mean, to your point, I mean, on digital assets, that certainly would lead to someone potentially looking at higher limits. And then if you're a hedge fund and you're running a short only strategy or a crypto sector specific type strategy, you would definitely be looking probably at higher coverage limits than you would for just a traditional long only, long short fund. But we see a wide range of coverage levels selected across managers.
And with strategies, are you looking at the number of counterparties they're trading with and the number of investments? Does that come into play at high frequency versus, low frequency trading?
Yeah, that's part of it. I would say the main in my conversations with underwriters, the primary thing that they're looking at is the PPM and the marketing materials because they want to see how this opportunity has been represented to the ultimate client or investor, because if something comes up down the road, they're always going to point back to when we first talked, this was kind of how you outlined the strategy to us and you didn't execute on it or it didn't work for whatever reason and I suffered a loss. And so just from our experience sitting in the broker seat, that's really where the underwriters like to dig in. And if there is an underwriting call with the insured, those are the types of questions that are often, asked about. Is just sort of how the opportunity was initially represented to the investor base.
That makes sense. Um, as far as claims that fund managers actually have and weren't expecting, can you talk about a little bit of like the most recent claims you've experienced and what that looks like for a fund manager? And if you have a real life example, that would be great.
Yeah. Yeah, I would say generally speaking, over the last 5 years or so, we've definitely seen more cyber liability claims than we have E&O D&O claims, and those tend to be higher frequency type claims, but not as severe in terms of total dollar amounts that you might see on the E&O and D&O. The cyber claims are almost always a function of human error, where an employee clicks on a bad link or a bad attachment, and the bad guys get in. And I mean, we've seen in the fund manager space specifically, we've seen several of those in recent years. For E&O and D&O, it's the claims are almost always driven by poor performance, rightly or wrongly. And so, at the point as we were just kind of discussing, the investor points back to how the strategy was initially represented, and then they try and make the case that the investment opportunity was kind of, they were led astray, misrepresented from the beginning. And so, depending on the profile of the investor base and then the strategy's ultimate performance, it's not uncommon to see millions of dollars in just defense costs of hiring lawyers to try and build your case and make your argument before we even get to the settlement or judgment phase. So those are the types of claims that we tend to see. Some regulatory type claims, but really the investor feels that they were wronged, and they come after the manager, the fund itself, and try and get made whole for the fund's performance. And so I think that's maybe something that fund managers don't think about quite as much, as just the defense cost piece of it, of how much you can rack up in legal bills over an elongated period of time before you even get to a ultimate settlement or judgment. And so I think that's the real kind of benefit of the insurance that we've seen in real life.
And I can imagine the cyber side of things is definitely very active. I mean, that's something I'm in front of all the time. We train our staff, have all
Oh yeah.
types of systems in place. Do you work with your clients on making sure they maybe have a SOC report and that their controls are in place, and just having trainings for their people so that they don't click on the wrong email?
Yeah, absolutely. I mean, that's a big part of the underwriting process for the insurance companies. They want to see that you have multi-factor authentication in place, that you have, SOC 2 compliance, that you do regular phishing training for your employees, that you have an incident response plan. We can provide guidance on that, but we also know some third-party cybersecurity firms that are specialized in this space that we can provide to clients. But from the insurance perspective, I mean, those aren't really nice to haves anymore. That's kind of table stakes for getting the most competitive policy in place. So we have those conversations all the time. And this, I would just say as well, I mean, this sector, asset managers, I mean, that's a huge target and focus for cyber criminals, just because that's where there's a lot of uh, very important data that sits at that level. Obviously, large amounts of money moving hands. So we've definitely seen them become more of a target for cyber criminals in recent years.
And based on your knowledge of the space, if you had to put a percentage on it, how many funds do you think actually have insurance versus ones that don't? And are there particular areas where they have a higher percentage of coverage versus, lower, newer funds?
Yeah, that's interesting. I would say, just based on the kind of our anecdotal evidence, I would say a lot of emerging managers, which I guess I'll call, 0 to 100 million in AUM, I would say probably more than not, they don't carry the insurance. And I think the reason for that is just, as you're getting going, you're very focused on your returns, obviously, and the expenses associated with the fund as you're starting out. And so they make their investor base when they're starting out might be, it could be incubator stage where it's just them doing a little proof of concept. It could be friends and family, and they just don't really see the risks as that high. So I don't have great data on, how many purchase versus don't purchase, but and we have a lot of conversations with folks that are, 0 to 50 million, and they, don't end up buying until they maybe get a little bit more scale, just anecdotally.
And I know for us, being the audit and tax professionals, we typically get onboarded when the draft fund docs are available for us to review, the structures being set up, and so on. That's a good time for us to give valuable feedback and get in front of everything. For you, is there a perfect time for a fund manager to reach out in the formation process?
Not necessarily. I mean, I think oftentimes when we tend to get a call when they start thinking about insurance is when they're really going out in earnest to start raising third party money that might be kind of outside of just that small network that they got started with. So where they might see the risks is low. So once they really start fundraising and signing up third party LPs that they may not be as familiar with as they were originally, kind of going on the road, meeting new people, trying to raise money. I think that's when insurance starts to become front of mind for folks, and where you can kind of see the benefits of it starting to far outweigh the costs that they might incur to put it in place.
I know in our space, the due diligence requirements have really kicked up over the last decade. I
Yeah.
probably do 10 to 15 calls a week on potential investors for our funds, asking all kinds of questions, getting comfortable with our firm's pedigree and background. Do you deal with that a lot on your side where you have investors of funds reaching out or requiring insurance?
Yeah, this has definitely become more common, and a lot of times the time that folks, first buy the insurance is when they have an institutional LP that will require that they carry $5 million of E&O or D&O insurance or cyber insurance to work with them. So that yeah, we are definitely seeing a rise in that. I'd also just say, I mean, we as part of the underwriting process, we also review DDQs and things like that come out, and even if it's not necessarily mandated in the docs, the LPs are asking a lot more questions around, okay, what kind of insurance do you have? What kind of cybersecurity do you have in place? So even if it's not, mandated by the investors, it's certainly something that's become front of mind for LPs when they're evaluating and selecting managers, just to know that they may have that indemnification in place if something were to go wrong.
Excellent. On my side, I went through all the questions I had. This is definitely very informative. Certainly appreciate you going through this. We'll certainly include more information on your company and the different policies when we send this out, and make sure we have your contact information in mind. So anybody that's listening to this, if you wanted to have a more in-depth conversation, feel free to reach out to myself or Patrick at any time. Appreciate your time today.
Yeah, no, absolutely. Good to be with you, Steve.
Thank you.